Could 2024 be different? That's what this video is about on New Year's Day. We're gonna go through what JP Morgan just showed us in terms of some charts. We're gonna go through my money market magnet thesis, which we posted about on ehack.com. Together, you're gonna get all the insights. And now keep in mind, gold course expiration, I had to push it back a little bit because there have been so many emails, and during New Year's Day, I took Jack skiing. It was his turn. Max was last week, so we got Jack. I didn't know what size he was for his fitting, so I actually used the iPhone measure tool, which I thought was actually kind of funny. But this was us on New Year's Eve, and took him in the bus to go to the Fresh Market in Park City. He got himself Prime, of course. And yeah, here's us snowballing. Not like in Rust, but otherwise, yeah, he's pretty excited. So I got some videos here, but that doesn't matter right now. What matters is, what about 2024? Well, let's go ahead and start with these Yikes photos, and then I want to talk about my magnet thesis. So the first Yikes photo that I really want to hit on is this one, which shows us the top 10 stocks in the S&P 500. And what the trend line is looking like. Here, let's just get Kevin out of here. I wrote Yikes in there, and I threw a trend line on there. And keep in mind, this is not the share price of these stocks. This is the weight of the top 10 stocks. So this could mean that the top 10 stocks either fall to get off that trend line, or they do nothing. Yes, they could do nothing, and everything else could rise in price. If everything else rises in price and these do nothing, then the weight of these would be lower, right? That's naturally how this would work. Now, it is interesting because when you look at the top 7, like the one laggard out of all of them has been Tesla, under the weight of interest rates. We've talked about that one plenty of times. There's always some drama going on with Tesla, interest rates and Elon. Put both of those together, you have entertainment. But Elon's always told us, hey, buckle up, because entertainment is your only guarantee. So in fairness, you had fair disclosure. This was another interesting one. Look at this. Corporate cash as a percentage of current assets by sector. Wow. This is insane. When you look at the companies that have the most money, first of all, it's mostly your growth stuff that has the highest percentage. Lowest percentage would be your utilities, consumer staples, materials, industrials. This makes sense. Your greatest percentage of cash, not a surprise, comm services and tech. Real estate even, comm services and tech, that's going to be, well, basically, those are your main growth plays, right? So keep that in mind. And yes, if you still want to email us, because we're so behind on those, we did extend the gold coupon until we get through all the emails. So email us at staff@meetkevin.com. We'll probably get through all of them tonight, if not first thing tomorrow morning, and then we'll change the price. So if you did want to bundle up and you didn't get an email reply yet, I'm sorry. The entire team has been out. I've been working on it. I was up late last night in Park City, waiting not only to celebrate the ball drop, but also responding to emails. So I was even trying to do it on the lift, but I'll tell you, that is a bad idea, trying to do emails on the lift while you're holding your poles and your glove that you took off and your anyway. Okay, so this fascinating. This massive amount of cash in tech and comm services actually makes me feel very, very excited about many of the companies that could benefit from where we're heading, potentially, with markets. I mean, look at what we wrote on eHack. Yesterday, we wrote on eHack, we had this large piece talking about the Fed's manufacturing lag, and we talked about ubiquity on there as well. And basically, this was this massive argument that, hey, there is a chance that we could basically have all of the manufacturing headwinds that we had during COVID, which turned into massive stimulus for the manufacturing sector, lead to a massive manufacturing pickup in mid-2024, which is interesting because that could be just as we start seeing a slowing of jobs. You could actually see a pickup in jobs for manufacturing. And who would be manufacturing? Well, as usual, your cash-rich companies. See, it takes about 2 years. We touched on this on ehack.com here. You could read the full piece there. But it takes about 2 years to actually get a factory up and running. So what a lot of companies have been doing is really this is too hot. Let me expose the dragon chain armor. Yeah. What a lot of companies have been doing is really the ubiquity approach. So Ubiquity, for example, they have this situation where they exploded their spend on inventory to the tune of some $487 million, where all of a sudden it looked like they were cash flow negative. They were negative cash flow, 145.4 mil. This is straight from their 10K in the quarter ending June 30th. That's actually when their year ends as well. At the same time, their stock-based compensation was jumping. So you've got here stock comp jumping substantially from $3 billion to 4.7. Those folks are likely selling because it's an uncertain time. At the same time, the company's negative free cash flow. Why? Because they're hoarding inventory. In fact, in their 10K, they say, why did we do this? The increase in inventories is a result of the strategic decision to secure inventory while components are available in an effort to increase product availability. That, I think, is what a lot of companies are going to do in 2024. Make sure the shelves are stocked. Companies never again want to be in a place where you have a boom like 2021 and the government's throwing helicopter money around and you don't have enough supply to deliver the goods. So I believe that cash-rich companies are going to do everything they can to make sure their supply chains are delicious, their inventory is stocked, and they're investing as much as possible into R&D and going forward, expanding and growing and advertising. In fact, that was another thing we talked about on ehack.com was this idea that companies, in fact, we have a whole trade desk piece here. Barron's, for example, sees trade desk as a big beneficiary of what could be a 30% increase from the last presidential cycle in political ad spending. $15.9 billion in political spending, which is an insane number. But it's not just because of money that campaigns have, it's also because of all the super PACs and the corporations donating money into into political campaigns for advertising or whatever. So I think what happens is the following, and then I really want to get into this piece right here, which is where we talk about my money market thesis. Okay, so I think you have companies that are relatively cash rich, dump money into advertising and manufacturing, pushing out more inventory like the ubiquity effect to make sure there's plenty of supply. Well, what happens when supply skyrockets and now you're advertising more? Why are you advertising more? You're advertising more because you're trying to induce demand. And the best way to induce demand is by advertising that your prices just went down. And I think deflation is going to hit hard in 2024. And the beneficiaries are going to be the manufacturers, potentially, as they come out of the manufacturing recession. You've had 13 months of straight declines in manufacturing. And so if companies advertise more and lower their prices and potentially take it in the margin, who benefits? Consumers with lower prices, but also the manufacturers. Nobody's touching the manufacturers right now. They're like China. You know, it's like, I don't know, man. I don't want to catch a falling knife, man. China, I don't know. How low is it going to go? Manufacturing, I don't know. How low is it going to go? I don't know, man. I think there is a chance you could see an advertising and manufacturing boom in 2024, which actually creates the jobs that help keep us out of a recession. But then you have the bear argument of, whoa, wait a minute, what about the inverted yield curve? You know, there are a lot of people who think the inverted yield curve is going to reinvert really quickly as we go into 2024, and we're going to see a stock sell-off again. Remember the last time the yield curve started going up? Okay, we went from like negative 80 basis points to negative 20. And when was that? July 19th through October 31st. I know very clearly because it was 3 months and a week of straight down in the stock market. And of course, that's when we did our reggae fundraise for househack. Come on, man. It's okay. It's okay. That's just, you had to wait for the attorneys. It would have been perfect to do it in June or July. It's okay. Hey, whoever got in, they get the 1-to-1 valuation. Everybody who didn't get in, they missed out because now the company's worth 50 to 100% more than what those shares went for. Go to the Househack YouTube channel. You can learn about where we're coming from with the valuation and everything. Just Househack Homes. It's linked in the description down below. Make it easy for you. Okay, so, but what about this inversion? Are we going to reinvert? Well, there are a lot of bears, quite frankly, right now, who are arguing, well, we're going to reinvert. and the Fed's going to cut rates, and stocks are going to tank because of this reinversion. Usually when we steepen, we go up in the yield curve, stocks go down. That's all you have to remember, okay? More steepening means stocks go down, usually. I actually wrote a piece on eHack while I was on the plane back over here from Park City, Heber actually. But anyway, as I was flying back over here, like, will we actually see the yield curve go positive again? And so I have this thesis. I want to be clear, this is a thesis. This is not a guarantee, but it's a thesis. I wrote this a couple hours ago. I worry that the money market magnet might actually keep the yield curve inverted much longer. See, and think about this just simply, okay? In order for the yield curve to reinvert, you really need people buying the 1 and 2 year treasuries, specifically the 2 year, because we look at the 10-2 inversion, right? So you look at the 2 year, that thing's at like 4.25 right now, okay? The 10's at we're like 3.85, so you're 40 basis points inverted, right? Because usually rates are higher on the 10 year. Okay, so stick with this for a moment. Even if you're not super into bonds, just try to run with this for a moment. You need people to buy 2 years. But 2 years are almost like cash equivalents, almost, because they're such short-term bonds. So why would people buy a 2 year to get a 4.25% yield when they could just put their money into money market funds and earn up to 5.5% on banks basically begging their customers to throw money into them? JP Morgan is. They beg me. They're like, bro, please put your money with us. Your househack funds, but the other househack funds, you already got a lot of your stuff here. Give us more, and we will give you 5.5% on a money market. And so I got to thinking about this because somebody actually asked me a question. I think it was on the Househack YouTube channel. Like, Kevin, is Househack still buying short-term treasuries? I'm like, no. Why are we going to buy 6-month, 1-year treasuries when we can get 5.5 on a money market and have liquidity tomorrow? Like, capital appreciation? I understand. I make that argument all the time. But really, the capital appreciation play is on a 10-year. On the shorter duration stuff, the capital appreciation, I suspect, won't be as desirable. So if you're really trying to invest in bonds for cap appreciation, you go 10-20 bonds, right? 10-20-year bonds. Now, sure, I have also made this argument, but wait, money markets won't last at 5% forever. Yes, but even if we get 5 rate cuts in 2024, what? Who cares? We're still at 4% on money markets. Okay, well, am I gonna, assuming the 2 year is still 4.25, which it probably won't be, am I really gonna dump my money markets to buy a 2-year bond for an extra 25 basis point? No! Money is sticky. And so it sticks in the money markets. And so not only do you have companies that are cash rich, and whoever owns all the money in these money markets is cash rich, but the question is, where does that money go? Well, for investors who are in money markets, I actually think the money goes to buy the dip on stocks when stuff actually starts dipping. Because right now, things are a little on the expensive side. I mean, take a look at this. Here is JP Morgan's S&P 500 valuation measures. And as you can see, we're knocking on the door of a positive 1 standard deviation on the right side. So we're a little elevated. Now, you see the little red box there? I drew that on there because I'm like, yeah, I mean, I know we're elevated, but look at that period of time there where the red box is. We were elevated for basically 2 years where we were well over the 1 standard deviation line. And then look at 1997 to 2001. That's called euphoria. Okay, that's euphoria. And we could be going back into euphoria. I'm not saying we should be there. I'm just saying we could go back into euphoria. And we could stay there for potentially 2 years. And then maybe we'll get our recession in 2026 or 7. Eventually, there will be another recession. Okay, so this is really interesting because, wait a second. 10-year yields falling, meaning people who want capital appreciation in bonds who buy the 10-year, they lead bond prices to go up on the 10-year. 10-year yield falls. That makes car loans and home loans cheaper. Okay, car loans, home loans cheaper, that's good. 2-year stays high because nobody wants it because money markets are high. So what does that mean? We're still inverted. In fact, I wrote on eHack that there is a chance we could have headlines soon that are like, the longest inverted yield curve ever, or since XYZ will finally come in 2025, recession will come in 26, whatever. We'll just keep kicking the can down the road. But the point of this is there's some really big takeaways from this. So number one, I actually think it is entirely possible that we see money markets not flood the market and create euphoria. Although we could see euphoria, I think money markets only move over, not when the S&P 500 and the NASDAQ 100, the tech index, are at all-time highs. I think they move over to buy the dip. Think about that. That's juicy. You got money in money markets. Are you going to buy at all-time highs? Nah, man, you're just going to wait to buy a dip. And so, in a weird way, you actually, again, reiterate the thesis that I've had for about 14 months now, which has been correct so far. Knock on wood, okay? I make mistakes too. But, and if you want to learn about my perspectives, the Gold course will tell you all about them. Stocks, entrepreneurship, the mistakes I make, and LLCs or corporate entities, tax benefits, not paying taxes in your life, the course member live streams, lifetime access, all new content filmed this quarter, including just a few days ago. Gold course, it's a bargain. And if you need to bundle up because you're already a course member and you want this one as well, all the new stuff in the Gold course, it's like a new way of presenting. Email us at staff@mekevin.com. So now I kind of forgot where I was. That's okay. Well, okay. So you have this Nike swoosh that actually gets supported because every time the stock market dips, the money market people come in and create a floor. So you have a floor. Every time the market goes down, you have a floor. And so that's why you create the Nike swoosh, because there's so much cash on the sidelines. So there's a lot in this, okay? I don't mean to be here and try to overwhelm. So let me try to make some simple bottom lines here. I think that's why folks like coming to the channel. I don't know. I try my best. I know it's not, like I don't do the market's gonna crash every single day stuff. That seems to be really popular right now, but I don't know. These are just like people who are super short or something who need some confirmation bias. I don't get it. But anyway, it's okay if you're short. If you're short, you should be paying attention to this stuff too. So what are the conclusions on this? Well, consider this, okay? So I think cash-rich companies, okay? So cash-rich companies, what do they do? Okay? 1, spend. 2, manufacture, okay? Now, on ads rather. Spend on ads and manufacture. Make more stuff, okay? That creates disinflation or honestly, let's just stop pussyfooting here. It's going to create deflation because supply likely skyrockets, okay? So the problem with this is as supply goes up, and demand doesn't necessarily move up, prices have to move down. Price equilibrium has to come down. And we believe by mid-2024, we have a lot more manufacturing online. What does that additional manufacturing online mean? That means more jobs for economy. More jobs for the economy means less chance of the dirty R, okay? All right. So at the same time, as you get more spending on ads and manufacturing, manufacturers that create deflation, what you get are people who want to speculate on bond capital appreciation who, what do they get? Well, they go for 10 years. 10 years fall. So what happens when the 10-year falls? Well, mortgage rates, HELOCs, like credit lines, and cars all become less expensive. So investing in things that homeowners buy or cars could potentially make really good sense for 2024. Your Restoration Hardware, Lowe's, Home Depot, whatever. We've broken all these out. The Trade Desk for the advertising side. And you go in expecting all the cash people on the side to just support or basically prevent the dips from getting too deep. As soon as the dips get deep, it gets bought. Obviously, all of this would be wrong if we get jobs data that comes out this week and, we have some poopsie doopsie or whatever that comes out on jobs. Again, I go to ehack.com. I just type in catalyst into the search. What do I get? We got JOLTS numbers coming out in 2 days. We got ADP numbers coming out in 3 days on the 4th. We got jobs numbers on the 5th, CPI on the 11th. So there's a lot here. But I think this is really fascinating because when you put all these pieces of the puzzle together, it's kind of like, That is really interesting. I think especially one of my favorites is this one, just because it really shows us that, hey, you know, just because things are elevated doesn't mean they can't be euphoric elevated for a while. Now, I did see this. I thought this was interesting. S&P 500 profit margins. Look, what I wrote wow about was not that profit margins were near the bottom, which I actually think that could get worse. But which usually it only gets worse in a recession, worth noting. But the trend is up. Like, look at that long-term trend since '01. Like, companies are just making more freaking money. Maybe it should go down. Oh, man. Yeah, look, that's my take here. Email us, staff@meetkevin.com. We're going to keep that pricing active probably through tomorrow morning just to catch up with all the emails. I appreciate y'all. Staff@meetkevin.com. See you on the next one.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than househack, nor am I presently acting as a market maker.